Most people lose money trading, not because the market is rigged, not because they weren't smart enough, because nobody told them the truth before they started. I spent months doing everything wrong, chasing setups, revenge trading, blowing accounts I couldn't afford to lose. And looking back, every single mistake came down to 5 things I simply didn't know. This video is the conversation I wish someone had with me before I ever placed my first trade. Part 1. The market doesn't care about your opinion. This is the first thing that breaks new traders. You do your research, you read the news, you study the chart, you convince yourself the price is going up, and then it drops, so you hold, because you're sure you're right, and it drops more. Here's what took me too long to understand. The market is not a test of who did the most research. It's not rewarding the smartest person in the room. It's a mechanism that aggregates the behavior of millions of people, institutions, algorithms, and emotional decisions happening simultaneously. Your opinion is one signal in an ocean of noise. The traders who last are not the ones who are right the most. They're the ones who are wrong efficiently. They cut losses fast, stay humble, and let the market tell them what's happening instead of arguing with it. So before you place a trade, ask yourself one question. What has to happen for me to be wrong? If you can't answer that clearly, you're not trading, you're guessing with money. Part 2. Risk management is the actual skill. New traders think trading is about finding the right entry, the perfect setup, the exact moment to get in. That's not where accounts are built or destroyed. Accounts are destroyed by position sizing. Most beginners risk too much on a single trade. They see a setup they like and they go heavy. And when it works, it feels like confirmation. When it doesn't, it wipes out 5 previous wins in one move. The rule that changed everything for me was simple. Never risk more than 1 to 2% of your account on a single trade. That sounds almost insultingly small, but think about it this way. If you have a $1,000 account and you risk 2% per trade, you can lose 20 trades in a row and still have money left to keep going. 20 consecutive losses, and you survive. Now pair that with a reward to risk ratio of at least 2 to 1. For every dollar you risk, you're aiming to make 2. Suddenly, you only need to be right 4 out of 10 times to be profitable. That's not a high bar. Most beginners don't realize they can lose more than they win and still make money. That's the math nobody explains. Part 3. Your psychology will betray you. The charts are the easy part. Your brain is the problem. There are 2 emotions that destroy traders at every level: fear and greed. And the dangerous thing is they don't announce themselves. They disguise themselves as logic. Fear shows up as cutting winners too early. You're up 15% on a trade, you get nervous, you close it. 2 days later, it hits your original target. You made a fraction of what you should have. Greed shows up as holding losers too long. The trade is down. You tell yourself it'll come back. You move your stop loss. You average down, and then you watch it go to 0. Both of these feel completely rational in the moment. That's what makes them dangerous. The only real solution is a system. Written rules, entry criteria, exit criteria, stop loss levels set before you enter, profit targets defined before you enter, and then the hardest part, you follow them. No exceptions, no gut feel overrides, no just this once. Discipline in trading is not a personality trait, it's a practice. You build it by following your rules on small trades until it becomes automatic. You do not develop it under pressure with real money on the line. Part 4. Timeframe mismatches will confuse everything. This one is subtle, but it destroys a lot of beginners quietly. Every chart you look at tells a different story depending on the time frame. A 1-minute chart might show a strong uptrend. The 1-hour chart of the same asset shows a clear downtrend. The daily chart is ranging sideways. All 3 are technically correct. All 3 are describing the same asset at the same moment. And if you don't have a primary time frame you operate from, you'll find reasons to enter trades based on whatever time frame tells you what you want to hear. Pick your time frame based on your lifestyle. If you have a full-time job and can only check charts once or twice a day, you are not a day trader. You're a swing trader, and that's completely fine. Swing trading on the 4-hour or daily chart is more forgiving, requires less screen time, and removes the chaos of intraday noise. If you have flexible time and want more frequent setups, shorter time frames work. But go in knowing that lower time frames are noisier, faster, and psychologically more demanding. The rule is simple. Pick one primary time frame. Do your analysis there. Only zoom into a shorter time frame to refine your entry. Never use a shorter time frame to justify a trade your primary time frame doesn't support. Part 5. Consistency beats everything. This is the one most beginners never reach because they quit before they get here. Trading has a learning curve that is longer and more brutal than almost any other skill, and the market has a specific way of teaching. It takes your money first and gives you the lesson after. That's the deal. There is no way around it. The mistake most people make is treating their first few months like a performance period. They expect to be profitable fast, and when they're not, they conclude trading doesn't work or that they don't have what it takes and they stop. The traders who make it treat the first year as a tuition period. Every losing trade is information. What was the setup? What did you feel when you entered? What made you exit when you did? You journal all of it, not because journaling feels productive, but because patterns in your mistakes only become visible when you have data. The goal in your first year is not to make money. The goal is to build a process that is repeatable and survives contact with the market. Profitability is what happens after that. Start with a demo account. Learn the platform. Test your strategy with no real money on the line. Then move to the smallest possible live account. Not because the money doesn't matter, but because you need to feel real emotions, real fear, real greed, in a context where the damage is limited. Paper trading removes those emotions entirely. They come back the second real money is involved. Build slowly, stay in the game. The traders who win long-term are not the most talented. They're the most consistent. The market will humble you. That's not a warning. That's just the nature of the game. The 5 things I just walked you through, detaching from opinion, managing risk by default, controlling your psychology, respecting time frames, and staying consistent, these won't make you a great trader overnight. But they will stop you from making the mistakes that end most people's trading journey before it even begins. If this helped, leave a like and I'll see you in the next one.